The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, it's my Chanticleer colleague. He's Channel 9's biggest star now that Carl Stefanovic is gone. It's Anthony McDonald. How are you, Anthony?
Has the Today Show called yet, James? You'd be great on breakfast today.
Oh, thanks, mate, but no. This week, we wonder what all this bad economic news means for the second half of the year. We ask whether KPMG can stem the bleeding by changing its board. And we take a great question on mining strikes and their national interest.
The first of the big news in here, James, and while Iran launched a drone attack on a Singaporean flagged ship to put the Strait of Hormuz reopening in jeopardy, there's a bigger story much closer to home. Carl Stefanovic had dropped his own podcast bomb on Nine, our employer, and he's gone from the Today Show after 20 years. So we now have no Carl on morning TV, no Carl Sandilands on morning radio. What is it with the Carls and Kyles of the world? James, has societal change caught up with them? Or is this a story about old media versus new?
Well, I think the first question, Anthony, is will we ever be able to go by just our first names? Do you think people will say Anthony and James and they'll immediately know who we're talking about like we can with Carl and Kyle? I mean, it's a silly thing, but it does go to like the way these guys have entered the zeitgeist. I mean, these are seismic moves. To lose two people like this from mainstream media, as you say, does capture something that's happening. I reckon it captures two things that are happening. One, these are legacy media formats, radio and TV, that are not as relevant as they were 5 years ago, 10 years ago, 25 years ago. These industries have changed, and I think the notion of what makes a star in these industries and the power of those stars, that's changing as well. And then I think we've got this other societal political change that both Kyle and Carl are parts of. You know, Kyle Sandilands, he's always been an outrage merchant, absolutely loves it. But we've seen Carl Stefanovic really move into this area in the last, 12 months or so, where he's trying to position himself as a sort of Australia's version of, Tucker Carlson, Joe Rogan, somewhere on the right over there. And that mirrors the change in Australian politics. You know, we were talking last week on the podcast about this 30% support for One Nation. So the society is splintering and moving left and right, and I think Carl has tried to follow that. I mean, about 2 months ago, Carl published a video on his social media. It's very weird. It was a sort of AI-generated nostalgia-scape mourning the loss of an Australia that Carl said he loves, and he couldn't stop talking about what's destroying it. It was quite jarring, but I guess that's where Carl thinks people's heads are at, and he's trying to move back in time towards this more nostalgic period. I guess he's just trying to capture that zeitgeist.
Well, at the risk of sounding like Australia's youngest boomer, there's something in this podcast YouTube thing, James. There's eyeballs in it. But what we're seeing is, like you said, the successful ones, they sort of either got to go left or right of the political divide. They need to attract the people who want to hear the message, and they also need to attract the haters. And you need to be controversial to be talked about. And, what's happened with Carl, I mean, it's great PR for him now, and it's great PR for his new podcast. I mean, the setup, as it felt pretty untenable. It's quite unusual. I mean, media's a talent game, and, he's a much bigger name than you or I, so he can get away with stuff that we never could. But could you imagine doing a side podcast, James, getting allowed to do a side podcast where you're interviewing these sorts of people? Like, no one else is getting away with that. So I don't know. Good luck to him. I mean, I'm sure this martyrs him in some people's eyes. The right people on the right-hand side of the culture wars, they'll be going off. I could see the tears in Sarah Arbo, his colleague's eyes this morning. Yeah. James, is it going to be like that when I get the boot?
I'd cry.
Oh, thanks.
Here's a question for you, Anthony, though. Well, this is a business podcast. Can Carl make this new branching out career, independent podcast thing work financially? Is the economics of that model good enough in Australia yet? I'm not entirely sure. I think that's a really interesting question.
Well, he's apparently on $2 million a year at Nine, and I'm sure he doesn't start off that on his podcast, but I mean, he's building something, James. But I don't know. It feels to me like there's a fair bit of momentum around that delivery of media, and where eyeballs go, advertisers normally follow. So I'm not ruling it out.
Yeah, very interesting. All right, Anthony, it was your turn to cover the big spill in aisle 4 this week. Shares in Judo Capital, a bank that lends to small and medium-sized businesses, and it's in the ASX 200. It nearly halved in one session on Thursday, halved, after cutting earnings guidance and revealing 3 troublesome loans in its loan book. Anthony, can you explain to me how just 3 loans going bad and the resulting $20 million in impairments can halve an entire bank's valuation? I mean, Judo's got a $15 billion loan book. 3 loans going bad, that's not the end of the world, is it?
It's a bit silly, isn't it? I mean, like you say, $15 billion loan book at Judo and about $80 million in loans to 3 companies combined. So that's $80 million combined. And they haven't gone completely bad, just a $20 million impairment. The company nearly halves. I mean, it's a drastic overreaction, but that's the market telling you it's worried about bigger things here, James. First of all, it's worried about the economy. So 3 loans that went bad or are looking a bit doubtful. One's a curtain and blind maker, one's a financial planner, one's a construction service companies, and they're in different states.
Wow.
Right? These 3 loans were apparently all fine when Judo went in the third quarter, so just a month or 2 ago, and went through and reviewed all of its exposures. Apparently they were fine, but very quickly they've all gone off the boil.
Yeah.
Now, they're 3 different businesses in 3 different states going off the boil at a time when business and consumer confidence has crashed. We've had 3 rate rises. We've got the fuel price problems. We've had the budget, and things are looking a bit shaky out there, right? So there's concerns that what's happened with these 3 little loans, they're just the sort of leading indicator about what could be coming in Judo's loan book more broadly.
Yeah.
The second thing, though, and this is probably the bigger one, is whenever you get a company so quickly suffer a decline in its business that only a couple of weeks ago when it's out talking to investors about it knew nothing about, that calls into question trust.
Yes.
Or whenever you see a big share price fall, 40% is a big fall, just think there's got to be trust or mistrust, loss of trust behind this. So that, at Judo, it's trust in the underwriting process, trust in how it monitors its loan, trust in its actual business model. How can it really compete with the big 4 banks? Is it just taking the risky stuff? I mean, Judo's been fighting those accusations for 10 years.
Yep.
But how can you have a small bank compete effectively, not just taking the risky stuff? The cost of capital is going to be higher than a big 4 bank. That's just a fact of life. And on a day like yesterday, those sort of trust issues can really run away from a company. It can get the trust back, but if it does, it's going to take time. So it was ugly. I mean, I'd call this the ASX's turd burger of the month, James.
Yeah, absolutely. Judo got a bit unlucky too. It landed on a day when there wasn't a whole lot of other corporate news around.
Yeah.
So every eye in the market was focusing on this and thinking, have these guys really got this under control? It's a pretty brutal call. Those banking analysts, they don't muck around. They're all veterans, very good at asking tough questions. And, I think, as you say, it's a long way back for Judo, not just because the shares are now 40% less than they were at the start of the week, but there is this sense that it will have to rebuild credibility with the market. And, what's that saying? Credibility goes up the stairs and down the escalator. So it's going to be a long road back.
Yeah, James, and the big story in capital markets globally this week is the chip wreck.
Yeah.
The red hot chip makers whose shares are mostly up, 200%, 300% or more thanks to AI demand. They wobbled midweek and it looked for a while like the AI boom's boomiest trade was all over. Now, a few days on, where are we up to? Is it a chip wreck or is the AI trade just going to roll on?
Well, I think the chip guys are okay again, Anthony. We saw a company called Micron Technology, which is America's biggest chip maker. It released a stonking result on Wednesday night. Now, profits, if we get profit growth year on year, Anthony, here of 10%, that's not bad.
Good year.
15%, very good year. 20%, excellent year. What about 1,400%?
Wow.
That's what Micron did.
10 times.
In the quarter ended May. And basically, it's because this AI demand is pushing up the prices of the memory chips that it makes. It hasn't got enough supply to meet demand. It can basically charge whatever it wants. And so it is. And it's making stonking profits, going to keep doing that for the rest of this calendar year. But, Anthony, there's a problem with that. We saw that on Thursday night. Apple announced that you'll be paying 20% more for your MacBook and
Ouch.
your iPad. Why? Because memory prices have gone through the roof. So that's one problem. AI is starting to feed through inflation in the real economy, not just the AI economy. Then there's another problem. Everybody's looking at how much money Micron and other chip makers are making, and they're thinking, hang on, who are Micron's customers? Oh, they're the hyperscalers, Meta Platforms, Microsoft, Amazon, Alphabet, Oracle. And they're thinking, so all those hyperscalers, they're pouring $1 trillion US into AI infrastructure this year. And the memory makers and chip makers, they're absolutely loving life because of that. But are the hyperscalers actually getting any return on the money they're investing? Or is it all just going to these chip and memory stocks? So I reckon something's changed this week, Anthony. Everybody's now thinking about, it's come into sharp focus again. Is this money that's being poured into AI infrastructure actually going to get a return, or is it just going to mean a big profit boom for chip makers and memory makers that lasts for 1 or 2 years and it's all done? And I think, look at a company like Microsoft. It was the one that teamed up with OpenAI first. It was seen as the leader, the big tech company that was going to lead the way in AI deployment, was going to actually turn this AI spending into something real. Its shares are down 30% since last August.
Wow.
Oracle's shares, another company that's supposed to be going to make the AI boom come alive, its shares are down 40% this month. This month alone. So what the market is telling you is that they don't believe that these hyperscalers are going to make a great return on these trillions of dollars they're investing in AI. That they're quite happy to keep backing these chip makers who are coining it at the moment. But I think that these longer term questions about the viability of the AI boom are really coming into focus now. And I think it's going to be, as it sets up for the second half of the year, it's going to be really interesting to see where this goes.
Yeah, the market's got a lot more selective about anything that needs capital to roll out these AI plans. So something like the chip makers, they don't, right? They just need to keep doing what they're doing and they're collecting super profits. Good luck to them. But something like Oracle, that's going to be very capital hungry and it's going to need to raise lots of capital. There's just a moment in markets now where people are like, hang on, there's a lot of capital hungry companies out there. Is Oracle really the one I want to be backing?
Yeah.
Or would I prefer to be saving my dollars for SpaceX or Anthropic, or Google just did a US $80 billion raising. So people are getting more circumspect. There's only so much capital to go around and they're looking for the actual winners, not just spraying it everywhere.
Yeah, that's a good point. OpenAI, we thought they would be one of the next big AI companies to list after SpaceX. Well, guess what? All of a sudden on Thursday night, maybe our IPO will have to be delayed by a year or so. I'm telling you, Anthony, something is changing in this market at the moment. I think we need to watch it pretty closely. All right, Anthony, let's get to our first big topic. And speaking of the second half of the year, June 30 is only a couple of days away. We're halfway through 2026, and things have gone a bit pear-shaped for the Australian economy, and we're all bunkering down for the second half. This week, we got a few more pieces of economic data, which, along with that soft update from Judo, paint a pretty grim picture for the run into Christmas. Economists are still talking about the prospect of one more rate rise, either in August or November, and the Strait of Hormuz is barely open. Our governments are throwing around cost of living relief, and inflation is just not going away, Anthony. We got some interesting data this week. What did it tell us about inflation?
Yeah, it was the monthly numbers for May, James. And remember, the RBA says the monthly numbers are not quite as good as the quarterly ones, but it's still watching them. Yeah. So headline inflation, that's the CPI, includes everything, up 4%. Eased off a bit, was 4.2% a month earlier, but it was still 4%. Underlying, or the trim mean, that's the RBA's preferred measure, excludes the volatile items like the fuel prices. It increased to 3.6% from 3.4%. So it went in the wrong direction. So we had one number up, one number down. I mean, the headline numbers, they're probably not as bad as they could have been. Economists were expecting that headline inflation, could have been well up into the 4%, and it came in at 4%.
Yeah.
The trim mean at 3.6, though, that's the one that's supposed to be in the 2 to 3% range, but seldom is. Remember, it was stuck in the ones for about 10 years before the pandemic, and then it's been in the 3+ since the pandemic. That's the really stubborn one. And what we learnt this month from the numbers, and I'd say we're getting this lesson every month, James, and we're quite slow learners, is that inflation isn't just sticky, it is stuck. right?
Hey.
Particularly around housing, food, transport. At the moment, that's the real fuel-impacted industries. And this inflation is not going away by itself. You know, the RBA is showing extreme patience. This trim mean number went up, and yet it sat on another rate rise 10 days ago. It doesn't expect inflation to be back in the middle of the range, James, for another 2 years. And yet it's happy to sit around with rates on hold. And why? Yeah, because they're nice guys. They don't want to crash the economy. It wants this, this soft landing, which is beautiful imagery. But there's no point getting a soft landing if the plane's touched down in Amsterdam. You want to go to Antwerp. Like if it's taking us to the wrong place.
Yeah.
What's the point of the soft landing? So, Philip Lowe handed over this soft landing last time around to Michelle Bullock. And they pretty much landed it, or nearly landed it, but unfortunately, inflation's gone again. Households are spending quite strongly, governments are spending strongly, business capex hot in a few places, including around data centres. And that's not just the RBA's fault, far from it, but they're the ones that are left to clean it up. So, and now, James, we're just coming through the government budgets and they just can't help themselves. Federal government, state governments, they can't help but just spray around bits of money, like the federal government's WATO, WTFO, workers' payment. That $250 a year that they're giving us. In New South Wales, had $100 off car rego, $150 a year back to school bonus in Queensland. Yep. I mean, you've probably still got the free public transport down there. Do you, James?
Half price.
Like the fuel excise, it's going back on at a quarter at a time instead of coming back on in full. All that stuff makes the economy harder to slow down. And it's not doing anyone long-term favours by running it hot. I mean, Bullock tells us every press conference, inflation is bad for all Australians, not just homeowners, not just renters, not just pensioners, not just the wealthy, not just the disadvantaged, everyone.
Yeah.
And yet we're in this place where inflation's running hot and rates are on hold.
Totally.
But,
I take your point that it looked like we'd achieved that soft landing.
Yeah.
But did the RBA stuff this up? What really happened is that the wheels bounced along the tarmac for a bit and then inflation took off again. This is the lesson this time around, isn't it? Bullock doesn't just need to beat inflation, she needs to sustainably beat it. We can't have a period where inflation's above target for 5 years and expected inflation expectations aren't going to move.
Yeah, like the government probably stuffed it, James, more than Bullock, but
maybe
the government's the boss. Like if you're sitting at work and something's gone wrong, the boss blames you. Really hard to blame them back, isn't it? You've got to try extra hard to be extra good at your job, so to make up for what's happening above you at times. Now, James, like the thing that's floating around in the air is the federal budget. It's just compounded the confidence crash. There's a lot of attention on house prices and what's known as the wealth effect. So when people feel better about life, when house prices are going up, they spend more, and vice versa, right? So if house prices aren't as good, they probably spend less and the economy has it tougher. James, how do you think everyday Australians feel about house prices going sideways or backwards? We're a month or so on from the budget now. For years we complained that house prices were too high. So are we okay with the heat coming out?
I think we're okay with it to a certain extent, Anthony. We had the Housing Minister, Claire O'Neill, declare a housing correction earlier this week. We saw Jim Chalmers, the Treasurer, immediately try and walk that back. But O'Neill's right. I mean, it's a housing correction. We're going to see prices fall somewhere between 5 and 7% across the country. And in Sydney and Melbourne, the falls are going to be more likely to be 9 and 10%. That's a correction. But you do have to put that in context. O'Neill said this week, we've seen house prices since just before the pandemic rise more than 50%. So a little bit of air coming out of the bubble, is that okay? I think most people would say, yeah, look, I've done pretty well out of my property ownership in the last 10 years. I can't complain too much. But there are side effects as confidence in the housing market cracks. We do see that wealth effect. We do see housing market confidence seep into broader economic confidence. And I think the other thing is falling house prices make it very hard to bring on new housing supply. If you're a housing developer up there, it's hard to get a new project going when prices are falling because everybody looks at your project and says, oh, should I buy today or should I wait another 6 months and see where prices are? So ironically, the government's policies, which are designed to make housing more affordable and improve supply, could have a bit of a temporary negative shock to supply. So I think people can cope with it at the moment, but housing's so ingrained into the Australian psyche. If the price falls accelerate in the second half of the year, say the RBA raises rates again, it's going to get ugly for the government. I mean, the political heat will be real. And, I think at the moment, what's holding everything together is unemployment data. We got unemployment data this week. The jobs market's still tight, as Michelle Bullock would put it, with unemployment falling a touch to 4.4%. And that's good news. More people have jobs. But, Anthony, how does that fit in with the sort of interest rates and inflation discussion?
Yeah, it's very interesting, James. Like for all the confidence crash, business and consumer confidence, and for all the RBA's expectations of economic growth slowing to, 1% or so this year, the jobs market is getting better for workers. Like you said, there are more jobs, 40,000 more jobs in May. Yeah. Unemployment rate down to 4.4% from 4.5%. I mean, the monthly numbers, once again, they do bounce around, and this was pretty much just a reversal of the April result. But if you step back, the jobs market, yeah, sure, it's cooled this year, but it's still pretty good for workers considering the rate rises, oil, other macroeconomic pressures. Michelle Bullock, I mean, she calls it tight, like you said. She was calling it very tight. So, I mean, I think there's a slight change in her description of it, which is for the better. But there's sort of no capitulation. AI job losses, I thought that'd be one of the big stories of this year.
Totally, yeah.
And we've seen a handful of headline-grabbing ones a couple of months ago, but it's not here yet, and it's definitely not showing up in the numbers. So, I mean, good news for Carl Stefanovic. If he wants a new job, he might struggle to get $2 million a year like he was on here, but I reckon is a good chance. What that means for inflation is it doesn't help the inflation fight, right? That's more money in the pockets of everyday Australians, which is a good thing, and we should very much encourage, right? But unfortunately, it also means more spending, more activity in the economy, and without the productivity growth, that just sends inflation pressures the wrong way. James, one thing I worry about, and if you think about, what we're talking here on the pod and what we say most weeks, and we hear from investors and CEOs, we're talking Australia down and the challenges here. Just looking ahead to the second half, do you think we're at risk of talking ourselves into an even greater slump?
Yeah, possibly. But I think the problem is we do need to talk ourselves into a slump. We need the economy to slow. Michelle Bullock keeps saying it to us. Unless the economy slows down, inflation will not be tamed and it will not come back sustainably towards the target. Now, Bullock's trying to just tug gently on the handbrake through what she says and what the RBA does with interest rates. She wants the economy to just slow enough to get inflation down without going into reverse, without a recession. But it's such a fine line, Anthony. They don't call it a narrow path to the soft landing for nothing. There is a good chance of, what they call a policy mistake where the economy will go into recession. Now, I think there's a few things pushing against that. AI spending's one of them. Unemployment is still low. I think that's a good sign. And I think the household wealth boom we've seen over the last few years will help us avoid recession. But again, all that good news is in a way bad news because it makes it harder to get inflation down. So yes, we're at risk of talking ourselves into a greater slump, but let's not beat around the bush. We need the economy to slow, and we need it to slow quite sharply to get inflation down. And if not, we'll just be facing higher rates for a much longer time than we are even anticipating now. I think that's the danger.
Yeah, it's a seriously fine line. All right, James, for our second topic, let's look at the fallout at KPMG. The accounting giant tried to pull the pressure valve early this week. The AFR's accounting guru Ed Tadros broke the news that Chairman Martin Shepherd, who for months has downplayed the extent of the scandal, would stand down ahead of his term ending in August, while two senior partners, Eileen Hoggett, who was removed as Chief Operating Officer early this month, and Paul Rogers, would also leave the firm. James, we see this time and time again.
Yeah.
When corporates like KPMG get called to Canberra for a grilling, we get heads on sticks. We've now got 3 more heads on sticks. Add them to former CEO Andrew Yates and National Audit Team boss Julian McPherson, who we saw in Canberra last week, and you get 5 big names. Is that enough bloodletting?
Oh, possibly, Anthony. When we see these corporate scandals, it's often the CEO and the chairman that get changed out. We've seen both of that happen now. It's hard to know who else is left inside KPMG that would make sort of a meaningful sacrifice to appease Canberra. I think all the big names at the centre of this have heading for the exit or have already headed for there. So we're probably in the realm of the bloodletting is done. But I think KPMG's sort of recovery plan and its, way out of this crisis is still pretty hard to see. What we saw in Canberra last week was really the reputation of this business being ripped apart, and particularly the reputation of the audit part of the business. And that is so important. I know I'm talking to a former auditor here, but all of the trust that is placed in a professional services firm, at the heart of that is the audit business, because the audits are such a vital part of the plumbing of capital markets in Australia and around the world. When a company gets audited and the auditor ticks off on the accounts, that says to everyone, yep, you can trust this account.
Yeah.
You can trust this company. You can trust this business. And so that, a professional services firm, an accounting firm, it lives on the trust that the audit division imbues on everyone else. So, it's just, this is such a sort of dangerous scandal, I think, for KPMG. It's going to take a long time to get out of this.
It sure will. Now, part of KPMG's response on Tuesday was the KPMG Action Plan, outlining a bunch of near and medium-term actions to end this mess, or try to, James. So it included, instating an independent chair and other independent board members, training staff on confidentiality and whistleblower protection, and a bunch of third-party reviews. Now, James, it wasn't quite Jerry Maguire's famous 25-page mission statement, but it was 5 pages and it looked the part, if nothing else. What did you make of the substance?
Oh, not much.
Yeah.
One line grabbed me from this action plan, and that's that KPMG is now going to look to corporate best practice in governance. And I just think that is remarkable. I mean, this firm's been around forever, and it's only now deciding that, corporate best practice is something we should aspire to. Come on.
Yeah.
This company has been in and out of the boardrooms of our biggest firms for decades, and it's only now decided, maybe we could borrow a few corporate governance ideas from them. That is it's appalling. And I know KPMG is not a company, it's a partnership, so it plays by different rules. I get that. But you can't have after a scandal suddenly decide, corporates have good governance standards, maybe we should adopt them. I mean, how KPMG watched what unfolded at PwC, the scandal that they found themselves in, and thought, geez, do you reckon an independent chair's a good idea? Nah, we'll tough it out, see what happens. I mean, these guys are dumb. It is a dumb decision not to have put these structures in place beforehand. And then you get, also in that action plan, they're going to do mandatory training for everyone in the firm around confidential information. I'm sorry? An accounting firm's entire job is based on handling confidential information all day, every day. There wasn't mandatory training in place already to help people deal with that. I mean, that's just amazing too. Again, that's 101 inside most big corporations. So I get it. They're trying. They've got to show that they're trying to move. But Anthony, please don't pretend that you didn't know all this stuff was important before.
Yeah, I agree, James. They're just words. They're just empty words. Like, if I ever have to write the Anthony McDonald action plan, please send me home and tell me to have a good look in the mirror. It's embarrassing.
Yeah. The heat's obviously on KPMG in Canberra, clearly. But Anthony, these guys are in boardrooms all over the country. What do you reckon is happening inside our boardrooms in terms of how they're looking at KPMG now?
This one's bigger than PwC inside boardrooms, James. Like PwC, it was a partner or a group of partners trying to look after clients, even if that was to Australia's expense. So it's a bit perverse to think of it that way, but they were trying to help clients. This was using a client's information to help the firm win more clients. So what's the worst breach of trust? Like, personally, I'd say ratting out the country is about as bad as it gets. But
yes.
In the corporate world, from the people I'm speaking to, it's ratting out your client, particularly a client of nearly 70 years, like Lendlease was for KPMG.
Yeah.
Boards are reviewing mandates. I've got no doubt about it. And I'm talking audit mandates, right? Like, even long-term KPMG audit mandates, recently appointed ones, older ones, you name it. They're assessing who from KPMG is involved, when they got involved, were they involved in Lendlease and what else has gone on in there. It's a very live discussion. I mean, the tricky bit is we're only a few days away from June 30. A lot of companies have a balance date of June 30 and they'll have the auditors in second half of July, first half of August to come in and verify their numbers. So it's too late to do any changes just yet. But remember, James, like audit appointments, they are subject to shareholder votes. This will be an issue at the AGM season, I think, later this year. Whenever KPMG's been put up for an audit appointment in the past, no one's blinked.
No.
You had four big options, PwC and KPMG, in my humble opinion, were way ahead of the other four. No one ever got sacked for appointing KPMG. Now, when KPMG's name comes up, people are going to be thinking, what are their links to the company? Are we sure about this? Can we trust them?
Yeah.
To your point, is the confidentiality training inside of KPMG going to turn around what looks like an issue?
And to your point, Anthony, does the chairman of that company want to stand up at the AGM and defend the appointment of KPMG to some pesky shareholder who might ask a question about it?
100%.
Yeah. I want to bring in a question here from Joseph in New South Wales, which I'll ask to you, Anthony, as our former auditor. Joseph's appalled by corporate governance in Australia and especially what's becoming evident at KPMG. He asks, how can an audit firm be deemed to be independent if they audit the same company for nearly 70 years, as in the Lendlease example? Should ASIC make it mandatory that the same firm cannot audit beyond 10 years? And the other conflict of interest that Joseph points out is when you've got ex-audit partners from a firm on a company subcommittee that's involved in the tendering for new orders. Do we need to make sure that conflict of interest can't exist anymore?
Yeah, good questions, Joseph. And it'd be better if we weren't even talking about this or weren't even thinking about it. Like, there's nothing productive in us sitting around talking about this. Like, the fact that we're talking about this in 2026, when our governance standards are supposed to have improved so much, is a bit of a joke in itself. In my personal opinion, auditing the same company for nearly 70 years, that's a bit off, isn't it?
Yes.
Like, what's wrong with a bit of healthy change? Should ASIC make it mandatory that the same firm cannot audit beyond 10 years? Well, I don't know. I don't know if 10 years is the right number or 20 or what, but maybe chair people out there should be thinking how it can be healthy for shareholders to have a new set of eyes, look over the books, to review accounting policies once in a while. Yeah.
Anthony, Ed Tedros, our professional services guru, he had a story this morning that a 10-year limit's been suggested by one of the proxy advisors, Ownership Matters. And so there is a bit of a push to get that time limit in place. And it's probably fair enough too. I mean, Ed had some great numbers in there. KPMG's ordered 19 companies for 20 or more years. And that includes Lendlease, as we said, at 68 years, ANZ 57 years, and Ampol 45 years. Now, some of those audit relationships have been around longer than I have. It's pretty extraordinary.
Yeah, and in regards to the people involved in these audit tenders, I mean, what Joseph's referring to here is, KPMG won the audit for Macquarie, the huge audit, arguably the number one audit in Australia to win. Macquarie's such a big, sprawling business, complex. You win it here in Australia, but it feeds your firm sort of globally. They won it off PwC, and they had a former KPMG person on the board there at Macquarie. KPMG also won the Westpac audit with Peter Nash, an ex-KPMG partner, on the board there. So there is a bit of this going on. And, I mean, the relationships run deep in the sector. If nothing else, that's a bad look. And it isn't just KPMG. It's all over town. I remember when I was in audit, right? So I was on the QBE account, auditing QBE Insurance. The signing partner on that, a lady called Jan Skinner, very good at what she did. She went from signing partner to KPMG. She joined the QBE board and was on there for 10 years. PwC is still in the account. A bloke called Scott Hadfield signed it last year. He worked in the same division as Jan Skinner does, now the signing partner. I mean, these relationships run deep, and unfortunately there's only 4 of these firms out there for boards to choose from. So it's a tricky one. Relationships in business are very important. Boards do trust these institutions. And normally I think it's okay to have one rolling from the other. Boards think it's important to have someone with audit experience on the board. They have an audit committee, and it really helps around balance dates just to understand what the auditor's pushing back against or not and how much leeway there is. But unfortunately, then something like KPMG happens and it can spoil it for everyone. It makes you just think, if nothing else, it looks bad. There's plenty of people out there with audit experience that may not be attached to your current auditor. Why not just appoint them? But like I said, James, the fact we're talking about this in 2026, personally, I find it quite frustrating.
Yeah, I agree, Anthony. This is stuff that should have been sorted out a long time ago. All right, Anthony, we'll come back after the break. I want to get you to tell us about a hot new float on the ASX. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. And Anthony, if you've been on the fence about becoming a subscriber to the AFR, well, have we got a deal for you? You can subscribe during the Fin Review's end of financial year sale to save on digital premium access and set yourself up for success this financial year. That sounds pretty good, doesn't it, Anthony?
You beauty.
The offer ends on June 30. Look, we can only endorse how good a product the Fin Review is. Not only will you get lots of insights from Anthony and myself, but you get the whole breadth of one of the best newsrooms in this country. So if you're looking for an end of financial year deal, that one ends on June 30, and we'd love to have you on board.
Sure would.
All right, Anthony. On Monday, we're going to get a prospectus for a new $900 million float. An Australian company called FDC Construction Holdings is going to be listing in the next couple of weeks. Look, it's not the sexiest name I've ever heard, but tell us a bit about what they do.
Yeah, it's not the sexiest company, James, but it's pretty sexy for the investors it's pitched to. So they've had their float underwritten this week. They've already gone out and sold enough shares to institutional investors that the whole lot's basically covered. This is, as the name suggests, James, it does constructions and fit outs.
Right.
It can be anything from, swimming pools to fit outs of Commonwealth banks and shops and all that sort of stuff. Got a lot of different customers and a lot of different clients. It's run by a pair of brothers, the Cottle brothers. They're making a stack of money. One thing that caught my eye on this float is they've got an employee share plan where the employees basically going to end up owning do own at the moment about 30% of the business.
Really?
So they've got a lot of long-term sticky employees who, good on them. They're going to make a lot of money at this float. They're going to be locked in for 5 or 6 years, so quite a long time to be locked in for to try and keep the magic going. But a lot of companies out there say they're people businesses and it's all about their people. Well, this is a company that's actually put its money where its mouth is on that, and they've actually had their staff quite heavily invested in it, and it's working for them.
Yeah, good on them.
So it raised a few $100 million, 12.3 times PE, so not a hugely expensive PE. List in a few weeks. Good luck, FDC.
Yeah, absolutely. Love to see a new company come to the ASX with a good story. On Tuesday, it's the end of the financial year, Anthony. We're talking about tax loss selling, which is when, I guess, investors dump their losers and try and accumulate some tax losses to offset their tax bill. We seeing any of that, Anthony?
Nah, this week it's been pretty quiet on the tax loss selling front. Maybe it was done earlier in June and we all missed it. Yeah, so like a lot of the dogs of the year, WiseTech Xero, for example, have sort of bounced back a bit this week. So yeah, a bit different on the tax loss front this year.
Bit of buying in our old mate CSL too, right?
CSL is being heavily bought. Yeah, I think there's quite a bit of institutional money saying that was the bottom. Let's own it from here.
Oh, you got to love a bit of bravery. Also on Tuesday, Anthony, we get the RBA minutes from the June meeting. I mean, we sort of know the story here. I guess it's going to be interesting to see what frame of mind the board finished up at. How hawkish were they?
Yeah, exactly. How close was it? How much did they really consider raising rates?
Yeah. All right. We love questions here on the Chanticleer podcast. We had one earlier about KPMG. We've got another one here from Johnny in Western Australia. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form by recording a voice memo on your phone, including your name and where you're from, and emailing it to us. And of course, there's a widget on the bottom of all Chanticleer articles at afr.com. We'll get our producer Iona to do the honours with Johnny's question.
Chooks, while you've been focused on debating the existential threat of big acronyms like AI and CGT, why haven't you extended your Shanti concern to the pending industrial action at Port Hedland's port? What precisely is the value proposition, or as the Prime Minister often likes to frame, the national interest in allowing unions to toy with the nation's most critical economic asset?
As a loaded question for you, Anthony.
Yeah, this is one for Carl Stefanovic's pod.
What do you reckon? I mean, what Johnny's talking about there is we've seen a steady increase in industrial action in the Pilbara, in our iron ore heartland of the Pilbara. And in the last few weeks, we've seen the threat of strikes at Port Hedland's port, which obviously would mean that some of the iron ore shipments, for a period at least, won't be getting through to customers in places like China and India. This is a really fascinating one. The Pilbara has operated for a long time without much union representation and without a whole lot of industrial strife. Suddenly it's feeling the heat from unions. I don't know, is Johnny right in there's scope for someone like the Prime Minister to step in here, or we're not quite at that point yet?
Well, Johnny's right that this is very much in the national interest. I mean, the volumes that go through those ports, I mean, that's Australia's biggest export. I don't think we're at that point yet, but the sort of unionisation of that workforce up in the Pilbara, it could be sort of one of those economic trends that we don't really think too much about, but it could have lasting consequences. So, Johnny, I mean, you're obviously closer to it in WA. Thanks for bringing it to our attention and putting it on the agenda because, I think it's worth talking about.
Yeah, look, I think that's right. I mean, we were over for the mining conference a couple of weeks ago. The miners are clearly worried about this. What are called rights of access requests have skyrocketed. That's where the union wants to come on site and talk to members and potential members.
Yeah.
Those requests have gone through the roof in the last 12 months. That's something the miners are having to get used to. They haven't seen that for a long time, and that is really shaking things up. I think the miners are going to have to live with an increased level of industrial tension. I think Johnny's right, that's going to have to be very closely watched because we don't want to interrupt this trade. I mean, I think I've said this before on the podcast. Imagine how fraught these discussions about the budget and CGT would be if iron ore exports were suddenly stopped. And that is the danger here, but that's also the leverage for the union. So Johnny's right. Governments in Western Australia and the federal government, both Labor governments, would want to be watching this pretty closely. This is not a time where we can really afford an interruption to the iron ore trade. And it is one to watch. All right, Anthony, thanks for another great podcast. Good luck with your auditioning for the Today Show over the weekend. I see a glow up and a new suit in order for you. So get down to the shopping centre this weekend.
Please don't tell anyone I'm interested. Try and do it on the quiet, James.
Fair enough. Well, thanks for listening. I promise Anthony will be back, regardless of if he has a new job next week. We'll see you then. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald. It was produced by Iona Rennie and Alex Gow. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.